Right now, Tesla stock is trading at $417.78, showing a powerful intraday surge of roughly 6.3%. You might see that green number and assume this is just another typical day of high beta volatility for the electric vehicle giant, or perhaps you believe this is merely a retail-driven rally fueled by hype. That is the expectation. The Tesla is simply riding a wave of sentiment. The reality, however, is far more mechanical and significant. What we are witnessing today is not just enthusiasm. It is a structural repricing of risk as the market finally digests the divergence between Tesla's stagnating automotive sales in Europe and its explosive, almost quiet dominance in domestic energy storage and autonomous software potential. Most people look at the ticker and see a car company having a good day. If you look closer at the order flow and institutional positioning, you see a capital rotation that suggests the street is beginning to value Tesla less as an automaker and more as a geopolitical hedge and an AI infrastructure play. The tension here is palpable because the retail crowd is cheering for the cars while the smart capital is quietly betting on the grid and the software stack. If you have been watching the charts, you know that the $400 level was a massive psychological barrier. Breaking through it and holding it changes the technical landscape entirely. We are seeing volume today that confirms institutional participation, not just day traders flipping contracts. When a stock of this magnitude moves 6% in a single session, it typically signals that large funds are chasing performance or covering shorts that they allowed to run for too long. The intraday low was around $401, and the fact that buyers stepped in so aggressively right at the open tells us that the bid is real. There is no hesitation here. The expectation was that after the recent run-up, we would see a sell the news event, or a healthy pullback to consolidate gains. Instead, the reality is a breakout that is ignoring traditional overbought signals. This forces everyone who is sitting on the sidelines to rethink their thesis. Are they late, or is this just the beginning of a move toward the previous all-time highs? Let's talk about what is actually driving this movement right now, in this very session. It is not just about quarterly delivery numbers or a new model announcement. The market is reacting to a complex mix of macroeconomic signals and sector-specific momentum. We are seeing a broader lift in the Nasdaq today, but Tesla is outpacing its peers significantly. This relative strength is what you want to see. When the general market is flat or slightly up and one name is rocketing higher, that is a signal of specific, idiosyncratic demand. We have seen reports of increased options activity, specifically in near-term calls, which acts as a magnet pulling the price higher as market makers hedge their exposure. This gamma squeeze mechanic is often dismissed as noise, but in the short term, it creates a self-fulfilling prophecy of upward pressure. However, we need to balance this bullish price action with the colder, harder data coming out of Tesla's international markets. You might have heard about the sales figures in Europe. They are soft. In fact, they are concerningly soft, with sales dropping nearly 50% in some key regions. The expectation is that this should crush the stock. If a growth company stops growing in a major market, the multiple should contract, right? That is the textbook response, but the reality we are seeing today contradicts that completely. Why? Because the market has decided, at least for now, to look past the hardware struggles in Germany and France. Investors are pricing in a future where regulatory hurdles in the U.S. are lowered significantly, potentially opening the floodgates for the robotaxi and FSD, or full self-driving, initiatives. The market is effectively saying, we do not care if you sell fewer Model Ys in Berlin if you are about to monopolize autonomous transport in North America. This is a massive gamble, but it explains the disconnect between the weak European data and the roaring stock price. This brings us to the institutional activity, which is the lifeblood of any sustained move. We have seen filings indicating that major players like Millennium Management and others have been adjusting their positions. When you see funds of this size adding exposure, they aren't doing it for a quick 5% trade. They are positioning for a multi-quarter trend. They are looking at the same data we are, the flattening auto margins, the competition from BYD in China, and they are buying anyway. This suggests their internal models are projecting value that isn't currently visible on the income statement. They might be modeling the energy business, Megapacks and solar, as a much larger contributor to bottom-line earnings in 2026 and 2027. The energy sector is starving for storage solutions, and Tesla is arguably the only company that can deploy gigawatt-hour scale storage at speed. While everyone argues about panel gaps on the Cybertruck, institutional desks are calculating the margin expansion from utility-scale battery deployments. Let's shift gears to the technicals because the chart is screaming right now. We mentioned the $400 breakout, but the next levels are crucial. If this momentum sustains, the next major resistance cluster is historically around the 450 to 480 range. If we clear that, we are in blue sky territory where momentum traders take over completely. On the downside, that $400 mark must now serve as ironclad support. If we dip back below it on heavy volume, this whole breakout could be a bull trap. But looking at the relative strength index and the MACD on the daily time frame, the trend is robust. It is extended, yes, but strong trends often stay overbought for much longer than rational investors think possible. This creates a painful environment for short sellers who look at the valuation metrics, the PE ratio over 200, and think this has to come down. The market can remain irrational longer than they can remain solvent, and right now the market is aggressively rationalizing a higher valuation. Comment below how many shares of Tesla stock you currently hold or if you are waiting for a pullback to enter. I am curious to see if the sentiment in the comments matches the bullishness we are seeing on the tape today. Now let's widen the lens and look at the company itself beyond just today's price action. At its core, Tesla is still misunderstood by a vast majority of the public. The common belief is that Tesla is a car manufacturer that competes with Ford and Toyota. If that were the reality, this stock would be trading at a fraction of its current price. The reality is that Tesla is a distributed energy and robotics company that happens to use cars as its first major hardware deployment. They are building a vertically integrated stack that includes power generation, solar, power storage, Megapacks and Powerwall, power consumption, EVs, and the software layer that manages it all, AutoBidder and FSD. The automotive business is the cash cow, the engine that funds the rest of the science projects. But that engine is sputtering slightly. We have seen price cuts across the board, Model 3, Model Y, eating into gross margins. The expectation was that these price cuts would destroy profitability. The reality was that they did hurt margins, but they also squeezed competitors who couldn't afford to engage in a price war. Tesla used its balance sheet as a weapon, bleeding out startups and legacy automakers alike to protect its market share. It was a brutal, tactical move that prioritized long-term dominance over short-term earnings per share. This is why the stock didn't collapse when margins compressed. The market understood it was a strategic moat-widening exercise. Then there's the AI component. We cannot discuss this company without addressing the massive compute clusters they are building. Tesla is arguably running one of the largest real-world AI training experiments in history. Every car on the road is a data collection node, feeding video back to the mothership to train the neural networks that drive FSD. The expectation is that self-driving is always a year away. The reality is that the latest iterations of FSD are showing step-change improvements in complex urban environments. It is not perfect and it requires supervision, but the rate of improvement is accelerating. If they solve this, if they truly reach level 4 or level 5 autonomy, the economics of the business shift from selling a $40,000 hardware product to selling a high-margin software subscription or operating a robotaxi. That is the optionality that keeps the valuation elevated. We also need to discuss the leadership factor. Elon Musk is a polarizing figure, to put it mildly. The expectation is that his extracurricular activities and political vocalization damage the brand. We have seen data suggesting that brand favorability among certain demographics in the U.S. has dropped. The reality, however, is that his alignment with certain political shifts could position Tesla favorably for regulatory changes in the coming years. It's a cynical take, perhaps, but the market is a cynical beast. It cares about cash flows and regulatory moats, not personality contests. The recent price action suggests that investors view his current political standing as a net positive for the company's regulatory battles in the coming years. Let's look deeper into the energy side of the business because it is often the most overlooked aspect of the thesis. While automotive revenue growth has slowed to single digits or low double digits in some quarters,